Everybody, Steven Sitkowski here. I am the Chief Investment Officer and co-founder for Market Mastery Group. And today, I want to tackle one of the most often asked questions, and that is, aren't options risky? So I've got some notes for you, and then we're going to use some real-world examples. So let's go through and take a look at the difference between risk and reward, and just this common theme that goes something like, well, I don't want to mess with options because options are really risky. And I hear that 70 or 80% of the people who trade options end up losing money. And that's all the information that the average person has, or it certainly seems to be their net impression. So here's the first thing that we need to talk about relative to risk. And that is the idea of being long an option versus being short an option. Let me put that in plain English for those of you who are new. Owning an option versus selling an option that you did not previously buy. Now, if you short an option and you are quote unquote uncovered, then you could put yourself in a very risky position. You could be obligating yourself to buy stock from somebody else or to sell stock to whoever it was that bought the call option from you. When you are long an option, and there's just two kinds of options, there's calls and there's puts. When you own the option, your risk is limited to whatever you paid for the option. So why don't we do this? You want to know about risk? Let's do a comparison, and we'll take a stock that everybody knows, right? Let's use Apple. That would be a good one. So if I were to look at a chart right now, Apple is trading for, at the time of this recording, $333.46 per share. Okay, so I have a question for you. If you went out and bought 100 shares of Apple, how much would you have at risk? $33,346. That's what would be at risk. That is the maximum amount of money you could lose if Apple, in fact, went to zero. Well, let's say, on the other hand, I owned the right to buy Apple for $333 a share. And let's see, we'll go, so the right to buy it for $335. What would I pay for that right? $10.15 per share. Now, options trading contracts, each contract controls 100 shares. So what is my risk? $1,015. That's the most money I could lose if I bought that call option and lost 100%. So in one case, if I own the stock, how much could I lose? $33,000. If I instead purchased or used options, how much money could I lose? I could lose a little over $1,000. You tell me, which is riskier? Well, which one are you risking more capital? Certainly that's pretty easy. Now, in terms of probability of making or losing money, that's another topic, and that depends on your own individual skill set, okay? So if you're involved in what is called a debit trade, in other words, you pay money to buy something, generally your maximum risk is limited to whatever it is that you paid to get into the trade. If you short an option, and if you don't know what the term short means, you shouldn't be doing it, but that's selling an option where it is not quote unquote covered, where you're not hedged, then you could put yourself in a high risk position, and people who aren't knowledgeable sometimes do this, and it's why options scare them to death. Next, how are we using the option? So we could use an option to speculate. We could use calls and puts to bet on the price of a stock to go up or down, and there's a certain level of risk with that. But there's another way to be able to use options, and that is for purposes of hedging. So let me show that to you. Okay, so let's say, sake of conversation, that I own Apple stock. And let's say that I want to be able to protect my downside, right? Stock's at $333 a share. If I do nothing, I'm risking $333 a share because Apple could, in theory, go all the way down to zero. Well, here's something I could do. I could step in and say for the next, let's go up. For the next 74 days, have the right to sell my stock for, let's say, $330. Okay. How much would I pay for that? I'd pay $9.90. So that would be my maximum risk, $9.90. That's like buying insurance. That insurance would pay me $330 a share if the price of Apple dropped below $330. So I'm risking $990 in order to insure an asset that's worth $333 per share. So when we are using options for hedging, not only are we not speculating, what are we doing? We are in fact protecting an existing position. We are being more conservative than if we simply owned the stock. Sort of refutes the old, hey, all options are risky, right? What if I did something known as a covered call? And I have a lesson on this site on covered calls. But basically, I am selling a call option against a stock that I own. How risky is that? The risk is that the price of my stock goes up and somebody calls my stock away from me. But whether that happens or doesn't happen, I get to keep whatever the premiums were for selling the call. And because I own the stock, the fact that I sold the call does not increase my chance of loss. In fact, it decreases my chance of loss by the amount that I receive from selling the call option. Kind of like hedging. It's another example of using options to lower risk, not to increase risk. We can use options, specifically call options, as a stock replacement strategy. Okay, let me give you an example of that, and we'll just stick with Apple since we're on it. I could, in fact, if I believed Apple was going higher, go buy Apple stock for $333 a share and take $333 a share in the form of a risk. Or here's something else I could do. I could go buy, let's say, the right to purchase Apple for the next year at a price of $260 a share. And if I did that, that option would cost $87, roughly, $87 per share. And for every dollar that Apple went up, I wouldn't make a full dollar. I would make 82 cents, however, so almost a full dollar, but I'm not spending or risking $333. I am spending or risking $87 per share. So you tell me, which one of those strategies, buying the stock or using a stock replacement strategy, which one of those seems less risky? With one, you're using a fraction of the money. And then people say to me, yeah, but if you buy an option and it expires, once it expires, it has no value. That's not true either. If you buy the right option and the option expires in the money, you are still entitled to receive the amount by which that option is in the money. Again, people are operating based on partial information. And that is really the problem. Oh, by the way, most of the time, we are out of these positions before the stock expires anyway. So if you really want to speculate, if you buy what is called an out of the money option, so with Apple, Apple's at 333. If you buy an option that gives you the right to purchase Apple for something more than 333, we call that out of the money. And the fact of the matter is, if you just sit on that option until expiration, there's a good chance you're going to lose 100% of what you paid for the option. But check this out. You have the right to sell that option anytime that you want to, and you're going to sell it before that option expires. Awesome, awesome stuff. Oh, one other thing that I'd like to mention to you. When you buy an option, you can also put a stop loss or a stop order. So let's say that I buy an option for $10 a share. At the same time I make that purchase, I could set with my broker a second trade that says, if the value of that option drops below 7, sell it automatically. So what is my maximum risk? $3 a share. So you tell me, how risky are options? Now, the fact of the matter is, it's all going to come down to what? It's all going to come down to what you know. Are you interested in learning how to make money regardless of whether a stock goes up, down, or sideways? Do you really want to learn how options work and the truth about their mechanics and the very best strategies? That's what we teach. I do a 2-day training class on a monthly basis. If that's something you'd like to participate in, tell you what, just click down on the link, get some information, and we'd be more than happy to invite you to a free 1-hour webinar where I teach the basics and do an introduction. Then you can decide if you'd like to go further. No cost, no obligation, just my gift to you. So thanks for watching. Click and register, and hopefully I will be seeing you shortly. Till then, God bless.